Okay, let's dive into the long game today.
Yeah, the long view.
We've got this really interesting list. 10 top long-term investments, supposedly for financial security, looking at September 2025.
Right.
And this isn't about quick wins, is it? It's about building wealth steadily.
Exactly. Our mission here is really to give you, the listener, a shortcut through this. We're not just reading a list.
Right.
We want to pull apart the core trade-offs for each one. You know, what's the risk? What's the potential reward? And maybe just as important, how much of your time does it actually take to manage?
That's key.
Yeah.
Yeah.
So by the end, you should feel, well, pretty well informed about the whole landscape.
And we should probably start with the basic truth of investing long-term, right? The foundation.
We have to.
History shows pretty clearly higher returns generally mean taking on more risk.
No free lunch.
The source material mentions the S&P 500 averaging around 10% historically. But that comes with some wild swings. How wild are we talking?
Oh, easily 50% swings in a single year, up or down. That's just, well, that's the price you pay for playing in the stock market long term.
Right.
If you can't sort of stomach that potential 50% drop, you probably won't stick around long enough to see that 10% average return.
Right. You bail out at the worst time.
Exactly. So maybe we should start with the options that really embody that kind of volatility.
Yeah, let's look at the high-performance options first. The Ferraris of the investment world, maybe, starting with growth stocks.
Good analogy.
The name kind of says it all. They promise fast growth, big potential returns.
Correct. These are often tech companies, think, you know, an NVIDIA, maybe Apple in its earlier days, or some hot software company. They pour basically every penny they make back into growing the business. So dividends, forget about it, usually.
Not until they're much bigger, much more mature.
Right.
So if they're not paying you now, what's the catch? What makes them so risky?
Well, the risk is that investors are paying a high price today for profits that might not show up for years, if ever, in some cases. It's what we call a high price-to-earnings ratio, or PE.
Right, paying a premium for future hope.
Exactly. And when the market gets nervous, like in a bear market or a recession, that premium just evaporates. Poof.
And the stock price tanks.
Tanks hard and fast. So you really need to be committed, like holding for 3 to 5 years minimum just to ride out those potential huge dips.
But the flip side is,
yeah,
that's where the home runs are hit.
absolutely. Find the next Alphabet, the next Amazon.
Yep.
The returns can be, well, almost limitless.
Okay, so that's growth stocks. What about their sort of slightly less famous cousin in the high-risk zone, small cap stocks?
Yeah, small caps. Stocks of, well, smaller companies. They haven't made it to the big leagues yet. They represent potential, the chance to find that next big thing. Amazon, remember, was a tiny small cap stock once.
That's a great point. And the insight there is interesting. With a big company, you're kind of investing in what they already have, their market share. With a small cap, you're betting much more on the CEO, on their ability to execute and actually grow the thing. That feels inherently riskier.
It absolutely is. They just don't have the same financial cushion. Less cash, harder to borrow money, often zero brand recognition.
So more business risk baked right in.
Definitely. And just like growth stocks, when the market gets scared, these tend to fall faster and harder than the big guys.
But again, the dream is finding that undiscovered gem, right? The one that gives you maybe 20% a year for decades.
That's the lure.
But finding that takes work. A lot of research. You really have to dig.
And that's the perfect transition, actually. If you want that growth potential, but maybe don't want investing to become your second job.
Right. You don't want to spend hours reading financial reports.
Exactly. Then you start looking towards diversification and stability. And the first stop there is usually stock funds.
Stock funds, like mutual funds, or more commonly these days, ETFs, exchange-traded funds.
Yep.
These seem ideal for most people, right? You're not buying one single company. You're buying a whole basket of them. Grouped by a theme, maybe, like all U.S. stocks or big companies, or following an index like the S&P 500.
Right. And just to clarify that ETF point for listeners, an exchange-traded fund, it's basically like a mutual fund, but it trades all day long on a stock exchange, just like a regular stock.
Much more flexible sometimes.
Yeah. But the key benefit of either mutual fund or ETF is huge. You get instant diversification, which means it's way less risky and requires way less homework than picking individual stocks.
Because you own a tiny piece of lots of companies.
Yeah.
So if one goes bust, It doesn't sink your whole investment.
Precisely. You get the average return of the whole group, which smooths out those wild swings we talked about compared to just holding, say, 2 or 3 stocks.
Okay, but there's a potential pitfall here too, isn't there? With diversification.
There is. You need to be careful how diversified the fund actually is. If you buy a fund that's really narrowly focused, say, on just one specific industry, like chemical companies or something,
Good.
you might think you're diversified because you own 20 chemical stocks, but you're still super exposed if something hits that entire industry, like maybe oil prices spike or there's a new regulation.
And suddenly all 20 stocks drop together. Not much diversification then.
Exactly. So broad index funds are usually the safer bet for real diversification.
Got it. Okay, moving from growth potential to something more steady. Income generators, dividend stocks.
Right. If growth stocks are the Ferraris.
These are the reliable sedans.
Yeah, pretty much. These are usually bigger, mature companies. They've got predictable cash flow, more than they need to reinvest, so they share it with stockholders as regular cash payments.
Dividends. Great for generating income. I know REITs, real estate investment trusts, are a popular type of dividend stock too.
Very popular. And generally, yeah, they're much less volatile than those high-growth names. Seen as safer.
But safer doesn't mean risk-free. There's a big risk here, right? What happens if the company hits trouble?
Ah, yes. The crucial risk. If a company that's known for its dividend runs into financial problems and has to cut that dividend,
Ouch.
the stock price can absolutely plummet. Investors see it as a huge red flag about the company's health, and they just flee.
So the stability premium disappears overnight.
Instantly.
Right.
But the reward, when it works, is that consistent cash flow. Often 3% or 4% yield per year, sometimes more.
And the best ones grow that dividend over time.
Exactly. You hear about the dividend aristocrats.
Oh, yeah, the legends.
Companies that have raised their dividend payouts every single year for 25, sometimes 50 years straight. That's like getting an annual pay raise just for holding the stock. A great inflation hedge.
Nice. Okay, next on the stability spectrum, value stocks.
Value stocks. These are kind of the opposite of growth stocks in a way.
How so?
They're considered cheaper based on fundamental metrics like a low price-to-earnings ratio. Their stock price is low relative to their actual current earnings, not future hopes, but today's reality.
So less hype, more substance.
Sort of. You're looking for stocks the market has maybe overlooked or unfairly punished. It's the classic buying a dollar for 50 cents idea.
Who are these good for?
Well, often attractive to more risk-averse investors. And they can perform pretty well, relatively speaking, when interest rates are going up because that future growth premium on growth stocks becomes less attractive.
Ah, interesting. And because they're already cheap.
They theoretically have less room to fall, less downside risk.
Right.
And if the market eventually realizes its mistake and revalues the stock higher, you get good returns without necessarily taking on that crazy growth stock volatility. Plus, many value stocks also pay dividends.
So you get potential price appreciation and income.
Double win, potentially.
Okay. And the final piece in this core stability section, the ultimate safety play for many, bond funds.
Bond funds, yeah. Basically a big pool of loans.
Loans to companies, governments, cities.
Right. Hundreds, sometimes thousands of different bonds all packaged together. Now, the returns are usually much lower than stock funds. Historically, maybe in the 4–5% range annually, sometimes less, especially for government bonds.
But the trade-off is safety, much less risky than stocks.
Significantly less risky. And they offer great access for individuals. Buying a single corporate bond might cost you $1,000 or more.
Yeah, minimums can be high.
But you can often buy into a bond fund ETF for less than $100. And that diversification within the fund really helps. If one company defaults on its bond, it barely registers in a fund holding hundreds of others.
Makes sense. So given they're so safe, what is the main risk with bond funds?
It really comes down to interest rates.
Ah, the wider economy.
Yeah, if interest rates in the economy rise, new bonds get issued with higher payouts. That makes the existing lower-paying bonds in your fund less attractive.
So the value of your fund can go down.
Exactly. And the reverse is true if rates fall. So while bonds are relatively safe compared to stocks, their value definitely isn't static. It moves with interest rate expectations, often driven by what the central banks are doing.
Okay, good to know. Let's shift gears now to the more automated, hands-off approaches. Options that need minimal time commitment. First up, target date funds.
Target date funds. Super popular, especially in things like 401k retirement plans.
Right. It's basically automated portfolio management.
Totally automated. You pick a year, your target retirement year, say 2050,
Okay.
and the fund does the rest. It automatically shifts your investments over time.
How does it shift them?
It starts aggressive when you're young,
Yeah.
lots of stocks, aiming for higher growth. Then, as you get closer to that target date, 2050 in our example,
It dials back the risk.
exactly, it gradually sells stocks and buys more conservative bonds, less potential return, but much more stability and capital preservation as you near retirement.
So you're consciously trading potential growth for safety.
You are. And here's a little tip the source mentioned, which I thought was interesting, because people are living longer now. Some advisors actually suggest picking a target date that's maybe 5 or even 10 years after your planned retirement date.
Why is that?
It keeps a higher percentage of your money in stocks for longer, giving it more growth potential to help make sure you don't outlive your savings. It combats longevity risk.
Clever. Okay, what if you want automation, but maybe more tailored to you specifically, not just a date?
Then you might look at a robo-advisor portfolio.
Robo-advisors, these have become really popular.
Yeah, it's a fully automated investment service.
Yeah.
You start by filling out a questionnaire, your goals, how long you plan to invest, how much risk you're comfortable with.
And based on your answers.
The robo-advisor's algorithm picks a portfolio for you, usually built from low-cost ETFs, like those stock and bond funds we discussed.
And it manages it all, rebalancing and everything.
Yep, all automated. The big appeal is often the cost.
Lower fees.
Generally, yeah. You pay a management fee to the robo-advisor, maybe around 0.25% of your assets per year, plus the underlying fees of the ETFs themselves, which are usually very low, like 0.06% to 0.15%.
So pretty cheap.
Yeah.
What about the risk level?
Well, the risk is just determined by whatever the robo-advisor puts you in, based on your questionnaire. It could be a super aggressive all-stock portfolio, or it could be something really conservative, almost like a savings account, depending on your answers.
Gotcha. Okay, moving away from financial products for a second. A physical asset that definitely requires commitment. Real estate.
Ah, yes. Bricks and mortar. Or maybe lumber and drywall these days.
Ah, right. This one's different. Needs a lot of cash up front, right? And closing costs, commissions, they can be high.
Very high. And the returns typically come from holding it for a long, long time, letting the property appreciate.
What makes it attractive despite the hassle?
Two big things, usually. Leverage the ability to borrow the bank's money to buy most of the asset.
Right, using a mortgage.
And specific tax laws that often favor property owners. Things like depreciation, mortgage interest deductions.
Okay. Now, the source material mentions a risk here about lack of diversification.
Yeah.
It says your money is tied up in one asset. But hang on, isn't real estate often seen as a diversifier away from the stock market?
That's a really sharp point, and it's about different types of diversification.
It's a good point.
Yes, owning real estate gives you asset class diversification because property prices don't always move in lockstep with the stock market. That's good for your overall portfolio.
Okay.
But the source is talking about concentration risk. If you own one single rental property and maybe that specific neighborhood declines or your city's main employer leaves,
Then 100% of that particular investment is at risk. You're not diversified within real estate itself.
precisely. Plus, you've got the stress of potentially high debt from the mortgage and the hassle factor if you're renting out repairs, finding tenants.
And paying the mortgage even if it's empty.
Right. Active management is often required. But the reward side can be huge returns if you buy right, manage it well, and hold on.
And eventually paying off that mortgage gives you great cash flow and stability, especially appealing later in life.
Definitely attractive for older investors heading into retirement.
Okay, last one on the list, and this one's unique. The Roth IRA.
Ah, the Roth. Crucial point here. A Roth IRA is not an investment itself.
Right. It's more like a container, a
Yeah.
special account type.
Exactly. Think of it as a tax wrapper. It's a legal structure that gives special tax advantages to whatever investments you choose to put inside it.
And those advantages are pretty massive, aren't they?
Huge. The money you put in is after tax, you've already paid income tax on it,
Okay.
but then it grows completely tax-free for decades, potentially. And the best part, when you take the money out in retirement, assuming you follow the rules,
It's all tax-free. Contributions and
now,
earnings.
all of it, completely tax-free. Plus, it can often be passed on to your heirs tax-free, too. It's incredibly powerful for long-term wealth building.
Wow. And what can you actually put inside this magic tax wrapper?
Almost anything we've talked about. You can hold high-risk growth stock funds in a Roth. or super safe IRA CDs that guarantee a low return, or those stable bond funds, dividend stocks, pretty much the full menu.
Okay, that covers the 10 options. Quite a range. Now let's try to pull it all together. The sources laid out 4 essential rules for long-term success. Maybe we can reframe them as clear action steps for you, the listener.
Good idea. Rule number 1, understand the risk-return foundation. Always.
Action step, be skeptical.
Right. You have to constantly remind yourself, higher potential returns always come with higher potential risk. If someone offers you guaranteed high returns, run. You're almost certainly missing a huge hidden risk somewhere.
Okay. Rule 2 was about strategy.
Commit to the strategy you choose. This goes beyond just knowing your risk tolerance on paper.
What's the action here?
Simple, but hard. You must avoid panic selling when things inevitably go down. The minute you sell an investment after it's dropped.
You lock in the loss.
Exactly. You turn a temporary paper loss into a permanent real one. Sticking to your plan through the dips is crucial.
Makes sense. Third rule.
Harness time as your ally. Time is maybe the single most powerful tool you have in investing.
How so?
A longer holding period, remember that 3 to 5 year minimum we mentioned, but ideally much longer, it just smooths out the bumps. Volatility matters less over decades.
So the action is patience. Be a long-term holder.
Be a dedicated buy and hold investor. And ideally, use dollar cost averaging, investing a fixed amount regularly to avoid the bad luck of putting all your money in right at a market peak.
Good practical tip.
Now,
Is my final rule number 4.
diversify. Always diversify.
Don't put all your eggs in one basket.
Never, because no single investment strategy, no single asset class works perfectly all the time. Markets change, economies change.
So the action step is
Use those low-cost index funds we talked about earlier. They make it incredibly easy to spread your money across different company sizes, different industries, even different countries.
ensuring solid average returns without betting the farm on any one thing.
That's the goal. Less risk, solid returns through diversification.
Okay, great summary of the rules. So to quickly recap the whole deep dive for everyone listening, we've contrasted those high-octane Ferraris growth and small-cap stocks with the steadier sedans like dividend and value stocks.
And a safety net of bond funds.
We looked at the automated ease of target date funds and robo-advisors.
And the hands-on commitment and potential rewards of real estate.
And critically, we clarified that the Roth IRA isn't an investment itself, but that vital long-term tax wrapper.
Right. And maybe connecting those threads leads us to a final thought. If the Roth IRA offers decades of tax-free growth, and time is the greatest reducer of investment risk.
Okay, I see where you're going.
Doesn't that raise a really interesting question for you as an investor? How should that incredible long-term tax advantage of the Roth influence your decision about where to hold your most volatile, highest potential investments, like those growth stocks or small cap stocks? Should you maybe prioritize putting those specific assets inside the Roth wrapper, where their potential massive growth over decades can be entirely tax-free, and where the short-term scary volatility matters fundamentally much less because of that very long time horizon? Something to think about as you build your own plan.